Hello, I'm Chuck Brown, Deputy Director of Open Sky Policy Institute. Nebraska lawmakers on Tuesday will continue to discuss LB 939, a bill to cut personal and corporate income taxes. As you may recall, Nebraska legislators cut corporate taxes last session as well, passing a measure that would bring the top corporate rate down to 7.25% once fully implemented. While much of the discussion so far is focused on the personal income tax cut proposed in the LB 939, a Revenue Committee amendment, AM 1780, would ratchet the top corporate rate down to 5.84% over a few years. While there hasn't been a lot of debate on the corporate tax cut, we thought it'd be good to talk now with Adam Thimmesch, a tax professor at the University of Nebraska Law School, about how corporate income taxes work, which will help us get a better understanding of implications of the bill. Professor Thimmesch, thanks for joining us. And if you don't mind, we're going to hop right into some questions.
Sounds good. Happy to be here.
So there's been a lot of discussion around this bill when they talk about the corporate side about achieving parity between the corporate and personal income tax rates, where both rates are the same. Can you talk to us a little bit about the concept of parity and whether or not something we as a state should be striving for?
Yeah, so parity is kind of an interesting idea to me. It's not one that I've traditionally run into necessarily as a tax policy goal. And as an academic matter, I could see where you would say, look, all else being equal, a firm should not face different tax rates depending on whether it operates as a corporate or a non-corporate entity. And so from there, the argument is we should have a parity of rates, and firms' tax rates should not differ based upon that. The trick with that argument, though, is we don't have to go very far into the real world to see that not all else is equal. So that parity might make sense and would be a perfectly laudable goal if that were the only difference between corporations and non-corporate entities. But in the messy world that we have, there are a ton of differences between these two forms of organization. So trying to seek parity in one way really is not what we would consider as a tax policy goal, because it hides or ignores all of the other ways that these two systems differ. I'll offer you just a really quick example. So if you say that Nebraska, it sets its tax rates the same, personal income tax, which is where a lot of the non-corporate entities will be taxed, and corporate income tax, let's set them equivalent, right? That's parity. It's also the case that every corporation that pays corporate income tax to Nebraska will get 21 cents on the dollar back from the federal government. So corporate income taxes, state corporate income taxes, are fully deductible at a federal level, which means that when Nebraska taxes a corporation, the federal government chips in a little bit. It's a way that the federal government helps to subsidize states, and it's out there, it's contested, but that's the way that the system works as it is. So when you think about starting at parity and the federal government chips in 21 cents on the dollar to the corporate income tax, the actual effective economic rate on corporations immediately becomes lower. Now, it's also the case that some individuals will get to take that deduction for state taxes. It's only about 10% of individual taxpayers who get to take that, and the deduction is limited. And so what you immediately see in just one example is that you can achieve parity on its face, but pretty quickly when you import real world conditions, you can't functionally achieve parity. So if you want to do that for a tax policy reason, I'm having a really hard time understanding the argument. If you just want them to be equal because you think equal tax rates look good, or even versus odd tax rates look good, that's fine. But as a tax policy matter, parity is not really something that we're out there able to or wanting to achieve.
Thanks. The next question is that we often hear lowering the corporate rate will encourage businesses to relocate or expand in Nebraska. Will lowering the corporate rate encourage businesses to come here?
Location decisions are always incredibly complicated. And as an intuitive matter, it might seem that, look, if we reduce the tax rate, firms that come here will get to retain more of their profits. And so, yeah, why wouldn't more firms want to come here? Again, it kind of seems like an intuitive take. The trick again is in the details and how the real world corporate income tax works. It makes that much, much more complicated. Got to tell a little bit of a story here, so bear with me. But in the early 1990s, Nebraska and a number of other states decided that the historic way that they had taxed corporations wasn't really working to their benefit. So historically, states would take into account where a corporation's property, payroll, and sales were. And they'd say, well, look, based upon some mixture of those things, we'll tax your income. And that worked fine, and it reasonably approximated where these national or multinational firms are earning their income. But states like Nebraska realize that if we take into account where your property, right, where your facilities are, if we take into account where you're paying people, that's a disincentive for a firm to move into your state because your tax rate is going to go up, your effective tax rate. And so what Nebraska did, which a number of other states did, was to adopt what's called a single factor sales factor method of apportionment. And without getting into the details, effectively what it means is we tax you zero based upon where your property or payroll are located. We gave the max benefit that we could in the early 1990s. We already don't take into account those factors. That worked well then, right? If that was your theory. The problem is that at this point in time, a further rate reduction doesn't have any more effect. So pick your favorite national corporation. Oh, we can do Microsoft or Apple. We're sitting on these computers. You know, they're making sales into Nebraska. If we pass a corporate income tax rate cut, they get the benefit automatically. They get a reduction on their corporate income tax. They don't have to move here. They don't have to hire more people here.
Right.
They just automatically get the cut. And if you say, well, the rate's lower, so wouldn't they want to move here? Or isn't there a greater incentive to expand here? Well, based upon the rules that we have, if they move here or expand here, it has absolutely no effect on their corporate income taxes. We don't take into account at all where your property or payroll are located. So those firms already get the full benefit of the corporate income tax rate cut without making any location change. So what does it come to, right? What actually will impact those firms and those location decisions? Well, that's when you start thinking about what taxes or other costs would go up if a firm were to move here. And that's when we start thinking about what the real costs of these corporations are going to be that would be increased if they moved here. Corporate income tax, it just doesn't work that way under the modern system.
Right. There's been a lot of talk about the benefits of corporate rate cuts flowing to out-of-state taxpayers. Can you walk us through why this is the case?
Yeah, as compared to other types of tax relief, the corporate income tax relief is largely going to flow out of state, not to Nebraskans. And that's largely because of who forms corporate organizations now and where they're headquartered and where their owners are. So something like 95% of business organizations today are not going to be formed as corporations, right? Your small mom and pop store or your local restaurant or whatever it is, it's not going to form as an entity that is taxed as a corporation. They're going to be an LLC or an S corporation or something that's taxed under the personal income tax. So when we think about who is paying the corporate income tax, the overwhelming majority of the state corporate income tax is going to be paid by large national and multinational corporations. Now, those are overwhelmingly not headquartered in Nebraska, and their owners are overwhelmingly not located in Nebraska. Something like 40% of holders of US equities are foreign individuals. So immediately a corporate income tax cut, you have to start thinking about where it actually goes. If it goes to the owners, it's going outside of Nebraska to that ownership group. If it reduces the corporation's effective state tax rate, there might be some executives who get bonuses. Those executives, again, think about your big firms across the country. Apple or Tesla or Microsoft or 3M or Toyota, whatever it is, the benefits here are going to flow to those corporations and their headquarters, maybe some of their employees, but the benefit doesn't come in to Nebraska. Will Apple reduce the price of a MacBook Pro in Nebraska versus South Dakota? No, right? So Nebraska consumers, it's hard to tie a direct line between the benefit. And so when you hear something like that, It's a tag along when thinking about where are most of the employees of these organizations located, and especially management. Where are their headquarters, and then where are their owners?
Great. Thanks, Adam. Is there anything else about this issue you think people following this debate need to know about?
Well, I think, obviously the state makes choices and there are policy choices. The big thing to keep in mind, in my view, in state and local taxation, and it's true of everywhere in life, and I think people know this intuitively, is that there's no free lunch. States subject to balanced budget rules. If you don't collect money from somewhere, there's a tag along effect. And if you're in the world where you want to cut taxes, then you can choose between the taxes to cut. The corporate income tax is one that is mostly paid by outsiders. It's something states usually try to do, is
Right.
not have taxes paid by their residents. And so for any set level of spending that Nebraska has, it's got to raise the money from somewhere. And if it's not raising it from the corporate income tax, it's necessarily raising it from either the personal income tax, right? People
Mhm.
largely living and working here, the state sales tax, people living and consuming here, or property taxes. And so it's sometimes convenient or easier to think about these in isolation. But the reality is that any dollar not collected through the corporate income tax has an extra effect. And those effects need to be taken into account as well. No free lunch. And so you've got to really take into account what you're sacrificing and what you think you're benefiting.
Great. Thanks so much for joining us today, Professor Thimmesch, and I'd like to thank everyone for watching.